day for most of you in the state of California, regardless of where you are in the state. We're glad at John Hancock to be back in the state of California. And just to begin with a little bit of context, if any of you on the line have done anything related to long-term care insurance in the state of California over the past few years, inevitably you recognize there's been a lot of change in pricing, a lot of change in product, and a tremendous amount of change in the various carriers that are doing business in the state of California. One of the biggest challenges that any of us on the carrier side of the business face in California is the state of the current regulatory environment. The product approval process in California takes longer than it does in any other state in America. And what happens in the rest of the country is that as we on the carrier side learn more about our claims experience, make changes to our product and pricing to reflect the current interest rate environment, we file a new product, we file new pricing in the rest of the country, and usually in about 4 months, the vast majority of states across America have approved it, and we launch it. The challenge we face is in California, sometimes product approval can take over 2 years, and it puts carriers in a bind when we look at our experience and where we need to price this product to match our claims experience. It begs the question, gosh, we've got product in the rest of the country that's priced appropriately. We've got a product in California that is behind the times and that we really need to get repriced quickly to match what we're doing in the rest of the country. It begs the question, should we even keep selling it if we realize that it's not priced appropriately? And for us at John Hancock, and we're not the only one, by the way, we've seen other carriers back out of California and take a while to get back, whether it's Genworth or a company, for example, like Mutual of Omaha that's still waiting and trying to get back in California. But it begs that question, why would we keep selling it if we know that it's underpriced? And our decision a couple of times over the past 5 years at John Hancock has been to say, hey, why don't we pull the product back until we get an approval from the DOI on a product that's priced appropriately. And that's what's happened for us this year. We recognized the stuff we were selling earlier this year was no longer priced appropriately, and we felt the only responsible thing to do was to pull back on it and wait until we got our new rates approved from the DOI. And the good news is we've got them approved. It's now December. Product has been reapproved and on the street for sale in California for the past month. And what we're going to talk about today is that new product that we are comfortable selling because it is priced to reflect claims experience in the current interest rate environment. Now, as I get started and I walk you through just the basics of how the product works, I want to preface our conversation with this. If you have ever sold our LTC product in California at any point in the past 8 years, the vast majority of features and benefits that we're going to walk through today are identical to the product you've been selling for the past 8 years. The reason for that is because the product approval process takes so long in California. When we need to make changes, we'll file new rates and we'll file an endorsement to the contract, but we don't file a new contract from scratch because it just adds to the length of the approval process. So if you're familiar with some of the ins and outs of the product from before, you're going to find that the vast majority of those ins and outs are still the same today. When we talk about how the product works, really basic stuff. I'm not going to dwell on these first few slides, but I do want to touch on the highlights. What we're selling in California today is tax-qualified long-term care insurance, just as you've understood it to be with any company over the past few years. It uses the standard tax-qualified LTC benefit triggers, meaning either you have a cognitive impairment or you need assistance with 2 of 6 activities of daily living. That's a pretty straightforward idea. You need to have your physician or a licensed healthcare provider sign off on the fact that you need that assistance. You satisfy the elimination period, and then we start paying for any care that you receive under an acceptable plan of care. This is a reimbursement product, pretty straightforward. We will reimburse you for actual charges incurred up to the benefit amount that you select, whether you receive that care at home, in a nursing home, or in an assisted living facility. It's also important to understand that as a reimbursement contract, any benefits that you don't use now remain in your pool of money for you to use at a later date. So if you've got a $200 a day benefit and you're only spending $150 of it, the $50 a day that's left over that you didn't spend still stays in the bucket of money for you to use at a later date and still grows based on whichever inflation option you selected when you bought the policy. Now, as far as applicant ages are concerned, there's a little change here from before. We'll take a look at an application for anybody between the ages of 18 to 75. We did bring that maximum issue age down a little bit. It used to be 79. It's now 75, but I think at the end of the day, when you look closely at who's really buying this product, it's people in their 50s and 60s, and we don't expect a big difference by bringing that maximum issue age down by a couple of years. Now, when you select the benefit amount, this is a niche or feature that's unique to our California product that works differently in the rest of the country. But on our California product, you choose a daily benefit for your nursing home. Once you select a daily benefit for the nursing home, the contract automatically gives you a monthly benefit for home and community care. And that's important. A lot of people out there, and I'll be honest, myself included, are big believers in the value of a monthly benefit because it gives people more flexibility when they receive care at home. Our California contract, even though you're picking a daily benefit for the nursing home, automatically gives you 30 times that daily benefit as a monthly tool to draw from when you receive care in a home or community care type setting. That's very important to know. Another small thing to point out to you, when you select that daily benefit for nursing home care, you have the choice in California of whether you want 100% of that benefit available for home and community care or 70%. I'll tell you from experience over the past several years, the vast majority, and I'm talking better than 90%, select 100% for home care, and then we just take that full nursing home daily benefit, multiply it by 30, and give you a monthly bucket of money to pay for home care. As far as benefit periods are concerned, you've got the ability to choose anywhere from 1 to 6 years. Small change here to point out, if you have sold our product in California in the past, 10 years was deleted when we relaunched last month, and to be honest with you, that 10-year benefit period only accounted for about 3% of our sales in California. So by taking it away, we're not expecting much of a change as far as how our sales pan out here. Now, let's talk a little bit about deductibles, the elimination period under the contract. You have the ability to choose from anywhere between a 30-day elimination period on the short end to a 3-year elimination period on the long end. Now, let's be honest, the 3-year elimination period is not a big seller for us. For that matter, neither is the 2-year. We see most of our sales, not just in California, but in the rest of the country, come in at that 90-day elimination period. Some people sell 60 or 30. Not many sell longer than that. One thing I want to point out to you, though, about those longer elimination periods where there's a little sales idea is maybe you bump into a client that purchased an LTC policy many years ago with a 3-year benefit period. And they wish that back when they bought that 3-year plan that they had bought more coverage. Maybe they wish they bought a 4 or a 5-year plan. You could take our product and use the 3-year elimination period to sort of match up with the 3-year benefit period on their existing policy and use this as sort of a wraparound policy to pick up after 3 years when that other policy runs out. It is a service day elimination period, so that means that any day that you receive care counts towards your deductible. One other thing I want to point out is that in order for a day to count towards your deductible for home health care, you have to receive a minimum of 2 hours worth of care. Now, that really isn't that big of a deal if you understand how home health care works. if you contact any home health care agency in your community, I'll tell you from experience, it is highly unlikely that any home health care agency is going to send a provider out to your home unless you're willing to agree to at least a 2-hour minimum. And I'll tell you, in a lot of cases, home care agencies these days are even imposing a 4-hour minimum. So from a practical perspective, that really doesn't make a big difference to people, but it's something that we just wanted to make sure that we point out to you. Now let's talk a little bit about inflation protection. Clearly, when you select benefits under a long-term care policy, having a meaningful conversation about the impact of inflation on the cost of care is a vital part of the planning process. We have made a few changes here to our inflation offering in California, and so I want to spend a little bit of time here. I'm going to just quickly walk from the bottom bullet point up to the top. 5% compound inflation protection is an option that's been available in our industry since it began back in the late 1980s. The challenge in today's marketplace is that 5% compound is such an expensive option regardless of which insurance carrier you purchase it from. And in today's market, 5% compound accounts for a very, very small component of total LTC sales. And I'll be honest with you, that is the reason we pulled out of the California partnership. Everything that we offer in California now is a non-partnership product. And the reason why, if you've been through partnership training, is that the California partnership mandates that if you want a partnership policy and you're under the age of 70, you have to buy it with 5% compound. Quote 5 compound for anybody, and you're going to recognize few, if any, of your clients can afford the premium associated with it. We finally decided, looking at the time we made this decision, how few of our sales were coming out of the California partnership because of the cost. It just didn't make sense to participate anymore. But we do have it available as an option. You're not going to sell much, if any, of it, but it's there. We also have our CPI compound inflation option, which for us over the past few years has been very popular. We'll talk in more detail about how that works in a couple of slides, but I want you to know it's there. The third option you see at the top bullet point is Benefit Builder. And we're going to spend a little time on Benefit Builder. In California previously, you could do 5 compound, you could do CPI, or you could do no inflation at all. No inflation is no longer an option in California. The default, let's call it the least expensive alternative that you can purchase from us now, is Benefit Builder. Its intent is to provide a price point that's similar to what other companies charge for a guaranteed purchase option, but unlike that guaranteed purchase option, Benefit Builder gives you the opportunity to grow your benefit over time at no cost to you. Think about that for a second. A price point like a GPO, but a benefit that still grows at no cost to you. Sounds kind of attractive. I'm going to tell you before we start, Benefit Builder is not for everybody, but for those on a budget, for those who are struggling with the premiums for a traditional compound option, Benefit Builder can be an attractive alternative with a more affordable price point, but that still provides some measure of automatic growth. Let's talk about how it works. If you purchase the policy with Benefit Builder, there are 2 ways that you can watch your policy grow over time. The first is automatically, where we provide for some measure of automatic benefit increases at no additional cost to the insured. Now, just to explain how this works, I want you to step back from this slide a little bit and want to talk to you about how insurance really works. If you have ever sold an insurance policy, LTC or otherwise, your client pays a premium every year to an insurance company. Now think about what happens to that money. When a customer pays a premium, what do we do with it at John Hancock? We invest it. We set it aside in reserves. We invest that money over time to provide a pot of money to pay our claims down the road. And in every insurance policy that you've sold, there is a number that insurance company carries on their books in their general account on behalf of every single policyholder. And every time the customer pays a premium, most of it gets credited to that number. And every year, if the insurance company earns investment return on that money, more money gets credited to your customer's number. You don't think about the number. You don't really talk about that number, but there always has been and always will be a number that's held in reserve for that specific customer. That's an important context to understand, because now I'm going to explain how that number is relevant to Benefit Builder. Here's what we do. Every year, at every policy anniversary, we figure out exactly what that number is and how much we've earned on it over the past year. And anything that we earn above 3% gets credited back to that customer in the form of a paid-up addition to their coverage. Now, maybe some of you on the line have sold life insurance before. If you have, I want you to imagine an old-fashioned, participating whole life insurance policy, one that pays dividends. You know how in life insurance with dividends work? Every year when the insurance company declares a dividend, that customer has an option to take the dividend as cash, use it to buy a year of term insurance, or they can also use that dividend to purchase a paid-up addition to their life insurance. And if you think about how those paid-up additions work, in any given year, your dividend may not buy you a lot of additional coverage, but if you hang on to that policy for 20 or 30 years, over time, you're going to wind up with substantially more life insurance protection than you started out with, really at no additional cost to you. That is the same concept that underlies Benefit Builder. Every year, we earn more than 3%. We take that excess investment return and we automatically credit it back to that customer in the form of a paid-up addition to their coverage. Now, in addition to those automatic increases, we also give that customer the opportunity to increase their benefits on a voluntary basis above and beyond the automatic increases that they're getting. Now, these voluntary increases in many respects work like a guaranteed purchase option, where every third year you have the opportunity to add an additional 10% to your policy's benefits with no evidence of insurability required. Now, there is an additional premium that you have to pay for the voluntary buy-ups, and those premiums are going to be based on your attained age. If you're under the age of 65, we will allow you to say no one time. If you say no once, we'll make another offer to you. If you say no twice, these offers go away, but you at least still get your automatic growth over time. If you're 65 or up, you say no to these offers once, well, then it goes away. And regardless of what you do, it goes away in all cases at the age of 75. Now, not bad, right? If you want to bump it up a little bit out of your own pocket, you can do it. But it's nice to know that regardless of what you do here, you're going to get some automatic growth. Now, I want to talk a little bit about how this growth works. Okay, people are going to ask you legitimately, nice concept, right? It's a much more affordable price point. But what is my policy going to look like in 30 years because of these buy-ups? Well, this isn't compound inflation. I want to be clear. Compound inflation grows quickly. Benefit Builder is going to grow much more gradually than that. But, you know, over 30 years, you can wind up with 40, 50, maybe even 60% more coverage than you started out with for a price point similar to no inflation protection. It's not a bad deal. The good news is this. Anytime you run an illustration for Benefit Builder, it's going to spit out a report that's going to show you exactly how this would work under a variety of different scenarios. Now, I'm going to show you an example of those numbers. Now, I recognize you probably need to get out a magnifying glass as you're looking at your screen on your computer. These numbers are pretty small. But I want to talk to you about how these numbers work and how you can have a conversation about them with your customer. This is a hypothetical scenario using a 50-year-old male with the married discount, preferred rates, and a $200 a day benefit with a 3-year benefit period. Now, the first thing that I want you to take a look at here when you're looking at this chart is I want you to look at the premium. That policy premium is $899 a year. Now, let's be clear. There are a lot of 50-year-olds that you work with every day that think that long-term care insurance is an expensive luxury that they can't afford, but that would sign up for coverage in a heartbeat if they recognized that they could get some level of coverage for $899 a year. Now, the first column we've got next to the premium is how the policy performs if we earn 3% or less in any given year. What that shows is that if we earn 3% or less for the life of the policy, you're always going to have the same $200 a day benefit that you started out with. Now, if you were my customer and I was trying to explain this, I'd say, look, I understand that it would feel like a disappointment if you bought this policy and your benefit never grew because John Hancock never earned more than 3%. But you know what? It's actually not as disappointing as it seems. And here's why. If I were to quote you an $899 a year policy with any other company out there, you still would be left with $200 a day for the rest of your life. Because the only way I could quote you an $899 a year policy is to sell you something called a guaranteed purchase option. And the only way your benefits grow under a guaranteed purchase option is if you buy more coverage at your own expense out of your own pocket. So really, yeah, Hancock earns 3% or less forever. You're no worse off than if you bought an $899 a year policy anywhere else. Now, I'm going to take you over to the 6% column next, and I'm going to explain why in a couple of slides, but bear with me for now. When we go over to the 6% column, the first thing you're going to notice is in the first 3 years, there's no growth whatsoever. Simple reason behind that, there's a 3-year vesting period. We need to have that policy on the books for 3 years before we have recouped our acquisition costs, met our reserve requirements, and now have a number that we're carrying on their behalf that we can invest and grow. Now, in year 4, whoa, let's break out the champagne and party hat. You just earned an extra 6 cents a day of daily benefit. Now, forgive my sarcasm there. 6 cents a day is no reason to get terribly excited, but let's also be clear, the person's 53. Let's hope they're not on claim yet. The other thing I want to point out to you, though, is why it's such a small increase the first few years. What I told you is there's a number that we carry on our books in our general account on behalf of every single policyholder. How big is that number in year 4? We've just recouped our acquisition costs. We're just beginning to establish and invest that policy reserve. To be honest, we don't have a lot of money invested yet in that person's name, and therefore there's, not a lot of investment return for us left to earn. So let's take this down to the bottom at age 70, which is still, by the way, a good 10 to 11 years before the average age of claim. At this point, we're now at $234 a day. You've got somewhere in the neighborhood of, 15 to 18% more benefit than you started out with at no additional cost to you, right? Not bad. Same premium as a GPO, but I got 15 to 18% more. But here's the most powerful part. At age 70, that's when the growth is just starting to take off. And now we're 20 years into the policy. Now we've got a pretty significant amount of reserves set aside in your behalf. And now you're going to start to throw off a fair amount of excess investment return if you make over 3% and start to see some growth. If I take this to the average age of claim, which I'm going to do for you, and which, by the way, the example that spits out in the illustration takes it out to like age 99. Give me just a moment here. If I advance to the next slide, and I now take this to age 80, and I guess we're going to have to deal with the marks that I put on the previous slide, but there we go, erase all drawings. I take this out to age 80, and now I'm at $281 a day of benefit, right? I've got 40% more coverage than I started out with, and I'm still paying my $899 a year premium at age 80. Not a bad deal. Age 81, I'm at $287 a day. Here's the point behind all of this. If you're going to buy an $899 a year policy anywhere else, you're not going to get any growth unless you pay for it yourself. Here, at the average age of claim, you've got 40–45% more coverage than you started out with, and you didn't pay an extra penny for it. I think that's powerful. Is that compound inflation protection? No, of course not. If somebody needs to see very significant growth, go buy compound. That's fine. It's okay. But for the broad swath of America's middle class that can't afford compound but can't afford this, is giving them the opportunity to have 40 or 45% more coverage at no additional cost significant? I think it's huge, because I think all of us on the line know that there are people we talk to every day that need and want long-term care insurance but desperately struggle with affording it, that would look at this as a far superior option to no coverage at all. And let's be clear, no coverage at all is what those people wind up with today, because when you show them a premium for compound, if they can't afford it, what do? They say, no thanks, I'm just going to pass and take my chances. This is a much better solution than taking your chances. Let's be clear about that. Now let's talk a little bit about some historical perspective. I took you over to that 6% column, and I told you there was a reason why. I want you to think about where interest rates are today, right? Interest rates over the past couple of years here have been at all-time historic lows, and they've stayed at fairly low levels for a fairly long period of time. People often ask me, what are you doing talking about 6%? When I'm getting like, 0.25% at the local bank. How do you do that, guys? That sounds kind of ridiculous. Even 3%, right? 3% sounds like a lot. It's actually not as hard as you think. Here's why. A couple reasons. First of all, when we invest for long-term care reserves, we're investing over 30 to 40 years. That gives us the ability to invest in the long end of the bond market, where interest rates are substantially higher than they are in the short end. Okay, that's the first thing. The second thing is 20% of the reserves that we set aside for benefit builder are invested in equities. We can't go more than 20 because we do need to err clearly on the side of conservatism. That's our job as a life insurance company. But having a little bit of equity exposure in there gives you the ability to boost those returns a little bit as well. The third thing I want you to be aware of, though, is I want you to ask you a question to think about. When I pay my premium for Benefit Builder this year, if I buy it today, how much of my lifetime of premium is exposed to today's interest rate? The answer is only this year's premium. The money I pay this year gets invested at whatever rates of return are today. The renewal premium I pay 3 years from now gets invested in whatever rates of return are 3 years down the road. And whatever I pay as my renewal premium in year 14 gets invested at whatever rates of return are 14 years from now. If you know what dollar cost averaging is, this is like a giant dollar cost averaging strategy. Every year I pay a premium. Every year it gets invested at whatever rates of return are at that time. I think most of us recognize that after years of historically low interest rates, there is not a lot of opportunity for rates to get much lower, but there is significant opportunity over time for interest rates to grow. The power of this is that it allows that customer to benefit from rising interest rates, and that, for many people, is a significant opportunity. Looking at long-term bond yields, I might add, when I look at the fixed income column here, give me just a second so I can bring up the highlighter here. When I look at the fixed income column, what happens is I look at a 10-year average on long-term bond yields, I'm looking at 5.3%. I look at a 20-year average, I'm looking at 6.1%. I think that's pretty significant, and again, reinforcing the idea that most people that buy long-term care own it for the rest of their life for a good 20 to 30 years. There's some substantial opportunity for them to experience growth under their contract. Now, my computer is being a little bit on the fussy side with me for reasons that I don't fully understand. Give me a second. Let me see if I can get this thing. There we go. So now that we've talked about Benefit Builder, let me just briefly touch on our other two inflation options. If you've got somebody that wants compound inflation protection, our most affordable option for compound growth is what we call CPI compound. Over the past, let's say, 5 to 6 years, CPI compound has accounted for the vast majority of inflation protection that we've sold. It's truly compound. It means that in any given year, your benefit will grow a certain percentage above and beyond what last year's benefit was. With CPI, what we do is we index it to the CPI for all urban consumers. And what that means is that when inflation is low, yeah, okay, let's be clear, your benefit's not going to grow that much either, but if inflation is low and costs in the economy aren't going up that much, you really don't need your benefit to grow that much either. And on the other hand, when inflation is high, this benefit is going to grow quickly, which is also a good thing, because you're going to need it to grow quickly to keep up with inflation. The power of this is there is no cap on the upside. If inflation literally spikes to 12% next year, you get a 12% bump in your benefit at no additional cost to you. The other thing that's important is that there is no downside here. If inflation ever goes negative, meaning in essence there's deflation in the economy, your benefit will not shrink. Now, as inflation creeps back up to its previous level, we do offset that deflation until costs in the economy reach where they were when your benefit left off. But if you look at the likelihood of deflation in the past 65 years, it's happened twice. It happened once in 1958. It happened once in 2009. I think when you look at the historical trend, deflation is the exception, and a very rare exception at that, right? Far more affordable here, I might add, than a 5% compound option, and it's pretty relevant to LTC for this reason. Most LTC costs are driven by labor costs and housing costs. Labor and housing happen to be the two biggest components of the CPI. Now, I know there's somebody on the line that's going, but Eric, but nursing home costs are going up at like 6% a year. Yeah, they are, but do you know what percent of care these days is provided in a nursing home? 20%. The other 80% of care, the vast majority of claim situations, are either provided in a home care environment or in an assisted living facility. And the growth of cost in home care is much, much lower, as well as the growth of cost in assisted living. And those two costs, which are the vast majority of claims today, are growing at a rate that's much closer to what we see with the CPI. So this is a very relevant number. Now, when you select CPI compound, in addition to the guaranteed growth that you get every year, you also have the option to buy up at your own expense above and beyond your automatic increases. Every third year, if you select CPI, you can add an additional 5% above and beyond whatever the CPI did. There is no underwriting. However, premiums are based on attained age, and you're going to have to pay extra for this part of it. If you say no to it 2 times, or if you're over the age of 75, these optional increases will go away, but again, you'll still benefit from the automatic increases that CPI is intended to provide. Now, the final inflation option we've got, and one that you'll solve very, very little of in today's world, is 5% compound. A lot of people ask me, how do you guys even offer that anymore if nobody buys it and it's so expensive? Well, there's a simple reason. The law requires us to offer it. It doesn't require your customer to buy it, but the law in every state requires us and every other carrier to offer 5% compound. The reality is it's just because of pricing today, very, very few people purchase it. Other built-in benefits in the contract that I just want you to be aware of. Built-in return of premium before age 65. Here's what happens. If you die before the age of 65, we will refund your premium minus any claims to your policy, to your beneficiary. If you die after the age of 65, well, there's no return of premium here. But particularly for the younger market, that can be an attractive benefit where, hey, if something happens, you pass away before you get to that retirement age where you're likely to use this, there's at least some money paid back to your beneficiary to show for it. Also has built-in waiver of premium. It begins once your elimination period is satisfied. So it's a pretty simple idea. If you're on claim with us and we're paying you benefit after you've satisfied your deductible, you don't have to worry about paying us a premium. We've also got a small bed hold benefit of 60 days per year built into it. This is useful if you've got somebody, for example, that is in a nursing home or in an assisted living facility and they need to leave, like to go to the hospital for surgery and they're out for 10 days. That nursing home is your landlord and they expect you to continue paying rent on your room even though you're not there. Through the bed hold benefit, we'll cover that cost so your room's available when you come back from the hospital. Caregiver support services is another small built-in benefit in the contract. What this is intended for is non-insured family members, and let me explain that. We, like most carriers in the business, offer a care coordination benefit for our policyholders, where if you go on claim yourself, we can help you identify care providers in your community, give you quality of care rankings on them, and even help negotiate discounts with some of those care providers so that when you go on claim, you don't get gouged by your care provider and burn through your benefit quicker than you need to. What's nice about caregiver support services is it allows you to access that piece for non-insured family members as well. Let me use an example. Let's say you're in California, but let's say your mom lives in Chicago. Mom's 84 years old. She just had a stroke. She got discharged from the hospital, and she's got some serious needs for help. And you're halfway across the country in California, and you're going, how am I going to find a facility for mom, or how am I going to find home care providers, and how do I know if these people are any good if I'm 1,500 miles away from mom? Well, you can access this for mom, get a list of care providers in her area, evaluate them based on the quality of care rankings, and the best part, you can even access the discounts we've negotiated for mom, even though you're the policyholder, not her. And I'll tell you what, if mom didn't have long-term care insurance and we were paying for mom's care out of mom's pocket, those discounts would mean an awful lot. So it's a nice benefit that's built into the contract. Respite care, 21 days per year. Hospice benefit, if somebody's terminally ill, you can access that during the elimination period to pay for palliative care that's provided at end-of-life kind of situation here. So international coverage, one small change to the way it used to be in California. It now works like the rest of the country. 1 year of international coverage. It did not always used to be that way in California, but we will pay for up to 12 months outside the U.S. if that individual receives care. Now, I do get, just to point this out, a lot of questions from people in California and say, well, you know, I've got a client that plans to retire abroad. You know, what do I do here? Is this really useful if they're outside the U.S.? Here's what I always ask. Question: where are the kids? Are the kids here in the U.S. or are the kids abroad where that customer plans to retire? Because here's the way this works in the real world. If the kids are abroad and mom and dad are going to retire outside the U.S. to be near the kids, and the limitation on international coverage is a problem. But if the kids are here in the U.S., here's the way it usually goes down. Mom and dad retire care abroad, they have a lot of fun for the 20 years that they're retired. One of them falls ill and needs long-term care. Usually they get their acute medical care abroad, but if it becomes a long-term care scenario, they want to be close to their kids, and they're probably going to wind up coming back to the States. And in this situation, now 1 year of international coverage actually does the trick. They can get that initial care while they're abroad, make arrangements to come back to the States to be close to the kids, gives them a year to do that. Now they're back in the U.S., and they're getting care, continue to be paid for under their contract, right? 3 riders available with our product in California, and I'll touch on each one briefly. The first is our most popular. It's our shared care rider. It allows a couple to share their benefit period with one another. To illustrate how it works, I'll use my wife and I as an example. We both own long-term care policies, and we both have a 5-year benefit under each one of our contracts. And we also have shared care. Shared care allows me to use my entire policy, exhaust my entire 5-year benefit period, and dip into my wife's policy after my policy is wiped out. That's nice. I'd rather dip into my wife's policy than have to dip into my checking account at that point and pay for the care myself. Anything that I access from my wife's policy through shared care, well, I'm using it. It's no longer available for her. But again, would she rather have me use her policy or have me use our joint checking account? If you were my wife, she'd have me use her policy any day of the week. Now, let's slightly different scenario. We both have 5-year policies. We both have shared care. Let's say I die without having used any coverage. Anything that's left over in my policy gets added to my wife's policy when I die. On top of that, my premium now goes away because I'm dead. And in addition to that even, after I've died and after we've transferred my benefits to her policy, the cost of the shared care rider is deleted from her policy on a go-forward basis. So it's a very valuable tool if you're dealing with a couple to cost-effectively share benefits with each other and maximize the value under the contract. The second rider is also a fairly popular one for us in California. It's called the Enhanced Home and Community Care Benefit. This rider waives your elimination period for home and community care. What that means is you essentially have first day coverage for home care. And very importantly, every day that we pay for home care under the rider counts towards the elimination period that's left for the facility. So if I need care and I can find a way to receive 90 days of care at home and have it paid for through the rider, when I move into the facility on day 91, hey, my elimination period was satisfied by the days John Hancock paid for me at home, which is a nice thing. So that's a fairly popular rider as well. The non-forfeiture rider, yeah, you know what, we sell very little of that, and I know that's also the case with most other carriers. So I really don't want to dwell on that, but the reality is I think by this point you've got a pretty good feel for how our product works. I just want to point out one final comment that will be new to you, and it's significant. We are the first carrier in California to offer gender-distinct pricing. Now, gender-distinct pricing is something that every major carrier has instituted in the rest of the United States, and most of us carriers have been doing gender-distinct pricing in the rest of the country for a couple years. The reality is men and women have very different claims experience. Kind of like life insurance, but different. I mean, gender-distinct pricing in life insurance is something that's been going on since the beginning of time, really, because men and women have different mortality experience. The reality is that women pay, all other things being equal, less for life insurance than their male counterparts because they have longer life expectancies, right? There's nothing controversial about that. It's just the way it is. In long-term care, women in a gender-distinct pricing situation wind up paying more. And it's for the same reason that they pay less for life insurance. They live longer. And the longer one lives, the more likely it is that they're going to wind up needing some sort of long-term care. And when they need long-term care, they're not going to die off right away like some of their male counterparts do. So the way it works is this, with gender-distinct pricing. If you have a married couple that are opposite sex, okay, male and female, together as a buying unit, the cost for the male and female combined would be essentially the same as what we would have charged under a unisex pricing scheme, right? So if you've got a male and female together buying as a family unit, the total cost for the both of them, that's pretty much the same we would have charged if it was unisex rates. What's different, of course, is the way we break it out between the male and the female. Now, that can go different ways. If you've got a same-sex male couple, well, now the cost for those two guys is going to be way less expensive than it would have been otherwise. On the other hand, if you've got a same-sex female couple, well, unfortunately, it means it's going to be more expensive. Even though we are the first to offer it in California, I want to be clear, we're not going to be the last. This is something that every carrier is doing in the rest of the country. And the reason we just happen to be the first in John Hancock in California is we're the first one to get our rates approved, but other carriers have filed gender-distinct rates in California, and they, too, eventually will get approved and launch those to the field. So it is something to be aware of. It's new in California. No surprise if you do business in any other state, though. We've been doing it this way, as others have for a long time. So you know what, with that, Dave, I think we've covered all of the slides in the presentation. Do you want to see if there's any questions?
Yes, thanks, Eric. I do appreciate it. I'm slowly going through and I'm unmuting people. Hopefully, if you have me on a speakerphone, if you could please take me off your speakerphone or individually dial *6 to mute yourself back off again. Otherwise, I pretty much got everybody unmuted. So are there any other questions of Eric about the California launch?
Hello?
Hi.
Hello.
Did you have a question? Hello? Eric, I've got a question for you. It's a little bit off topic, but is 2015 the year that the federal contract comes up for review?
I don't know for sure, but that sounds about right. The federal program it's a 7-year cycle.
Right.
And I don't remember if it was 2008 or 2009 that we renewed it, but it is coming up soon. Does that mean 2015, 2016? I'm not 100% sure.
Okay.
I'll just say it's a 7-year cycle, so
right.
Whenever it was last renewed, tack 7 years onto it, and that's when it is. And it's coming up. I know that.
Okay.
Hello, is anybody? Can I ask a question?
Please do.
Yes.
Oh, I'm sorry. I just came back on the line here. So I'm sorry. I noticed you said for long-term care. I had to cut away for a second. Did you say the women pay the same thing for men under your policy for long-term care?
No, this is a gender-distinct, we use gender-distinct rates, and what that means is that men and women are both going to pay a premium that reflects their actual likelihood of claim. And the end result is if I've got an opposite-sex couple that is applying together, a male and a female as a single buying unit, the cost we're going to charge for them combined is the same as what we would have charged under unisex rates. But if you have a single male or a single female, you're going to see a significant difference.
Okay, so the men will pay more because they're most likely going to go on claim. As a single male, they'll probably go on claim much more likely than the women will, is what you're basically saying.
Actually, it's the other way around. The guy is much more likely to die off before he needs claim. Women wind up paying more for the same reason they pay less for life insurance. With a longer life expectancy, one, it's more likely that they're going to live to an age where they need care, and two, once they need that care, it's likely that they're going to live longer and be on claim longer than their male counterparts.
Okay, so the women are still paying a little bit more than the men, basically.
It's about 40% higher for a female than it is a male, so it's a pretty good difference.
Okay, that's fair enough. And then the other thing earlier, when you talked about the mother in, let's say, New York, a mother in California, child's in New York, could you hit that point one more time on how they can use John Hancock services? Was that the policy or just the locating of a facility only?
That is the locating of a facility only. It is not access to the policy's benefits. But just let me give you a hypothetical. So you're in California, let's say your mom is in Chicago. She needs care and she doesn't have LTC insurance. At the end of the day, she's still going to have to pay for her own care, but you, as a John Hancock policyholder in California, could at least, through us, access a list of providers in mom's area in Chicago, get the quality of care ranking, so you can kind of make a decision about the best place for mom to get her care, even though you're halfway across the country. And importantly, you can also access the discounts we've negotiated with that care provider. So even though mom's paying for the care out of her pocket, she can at least get the discounted rate that we've negotiated for our policyholders.
Perfect, perfect. Thank you. And this policy is now fully available in the state of California, John Hancock?
It's been available
Correct.
since November 10th, yes.
Okay, and there are no paid-up options on this John Hancock plan at all, so they'll be basically paying for life.
Correct. The base contract is paid up at age 95, but no, if you're looking for like a 10-pay or a paid up at 65, we don't offer those solutions.
Okay, so the maximum they can pay up is to age, well, it's set so that if they're still around at 95, then the premiums would pay and they would have lifetime coverage there forward.
Exactly.
Okay. Thank you for being patient, and thanks again, Mr. Welling. You're a fine host.
Sure. Just keep in mind, paid up at 95, but it's not lifetime benefits. It's whatever benefit period you selected when you bought the policy.
Yeah.
All right, any other questions out there? All right, with that, we'll wrap it up. Eric, thank you very much. California, it's kind of nice to have some good news for you folks down there once again. Even though you're getting thumped with bad weather, we're glad to have a carrier step back into the state. Hopefully we'll have others follow suit here in the not too distant future. We do appreciate this, you spending the time with us today. I did record the session. It will be available for your review up on our site later on today, as are other webinars that we've recorded over the last year and a half. So with that, everybody have a great weekend and a happy holiday season. Thanks, Eric.
Thanks, everyone.